Hello everyone, and welcome to Virginia International University's MBA 610 Business Taxation course. Thank you all for joining us online this evening instead of being in class due to the issue that I spoke about last week. I appreciate your understanding of this. Tonight we want to talk about a couple of special deductions. These include the U.S. Production Activities Deduction, the Dividends Received Deduction. We want to talk about net operating losses and how they're treated. And then we want to talk about the sequencing of the deduction calculations, since several of these, if not all of them, are subject to certain limitations. However, to get to the amount that drives the limitation, we essentially are adjusting the adjusted taxable income. When we adjust the adjustable taxable income, we do it in a particular sequence so as to come up with a number we can then apply and use in the limitation calculation. And so the U.S. Production Activities Deduction was really developed with the American Jobs Creation Act of 2004. And its real purpose was to drive jobs creation. The deduction is equal to 9% of the lesser of either qualified production activities income for the year or taxable income before the U.S. production activities deduction. We see that it's limited to 50% of W-2 wages, and so that means it doesn't take into account 1099 wages. And we see that it's not an expense for financial accounting purposes. And so this means that on the GAAP, or generally accepted accounting principles, income statement, we'll never see this deducted from gross income in order to get to income before taxes. That's because it's an expense for tax purposes, but not to get to GAAP net income. And so this creates, as you all recall last week, we walked through a couple of examples where we talked about what a permanent difference was versus a temporary difference, with these differences being between net income and taxable income. This U.S. production activities deductions creates this permanent difference. And so there'll never be a time where this deduction expense is taken into account in GAAP accounting. It's solely a deduction for federal tax purposes. And so when we're talking about the activities income that we apply the 9% to, we're really talking about domestic production gross receipts. And this includes receipts from the lease, rental, license, sale, exchange, or other dispositions of qualified production property, that is tangible property, computer software, and sound recordings that are manufactured, produced, grown, or extracted in whole or in part within the United States, or gross receipts from qualified film production, or gross receipts from electricity, natural gas, or potable water produced within the United States. It also includes receipts from construction that's performed in the United States, and it includes receipts from engineering or architectural services performed in the United States for construction projects in the United States. So you see, it can include gross receipts from a lot of different sources, and this makes sense when we think about the real purpose of this. It was the American Jobs Creation Act of 2004, and so the point of this is to incentivize companies to create jobs, essentially. So the gross receipts come from a wide range of industries. Then we reduce that for expenses that are related to this qualifying income, including our cost of goods sold and indirect allocable expenses. And so cost of goods sold are obviously those costs directly associated with the production of those gross receipts. So it could be direct labor, direct materials, professional services. Indirect allocable expenses mean those indirect costs that aren't treated as a direct cost that are allocated to the receipts. And so, for instance, if you think about the president of the company or the legal department in the company, these are generally classified as selling, general, and administrative expenses because they do work across the entire company, or the entire company benefits their efforts and their expense. And so you can't assign their labor and expense to a single specific project unless we do it through allocating those on some basis. And so it's those gross receipts less those direct costs associated with generating those gross receipts, also less these indirect expenses that we can allocate against those gross receipts. Okay, and so last week we touched on this dividends received deduction. And you may recall that we walked through the example of where these gross receipts, these dividends received are subject to perhaps triple taxation. And so that is, and we're talking here about corporations that receive dividends from other corporations. So these are not individual or dividends paid to individuals and received by individuals. And so that triple taxation comes in, if you recall, where so company A pays company B dividends. Well, because dividends are paid in after-tax dollars, company A has paid taxes on those. Company B receives those, and but for this dividends received deduction, they would include those 100% in their gross income, and they would be taxed on those. So that's the second time they're taxed. And then they would distribute them to the shareholders of their company, presumably. And again, as we all know, dividends are distributed in after-tax dollars. And so those shareholders would also pay taxes on them. And so you can see there's this issue of triple taxation. And what is this dividends received deduction is meant to be is to try to make that a little bit more fair. And so what it essentially means is that corporations that own less than 20% of a domestic corporation may deduct either the lesser of 70% of the dividends received or 70% of taxable income before net operating loss, capital loss carryback, or dividends received deduction. And so here we get back to, with this second example, the importance of the sequencing of deductions when we have to take into account the limitations of certain deductions. So again, corporations owning less than 20% may deduct 70% of the dividends received, presuming there are no limitations that come into play, which we'll talk about. Then the exception to the taxable income limitation is that if 70% of the dividends received deduction creates a net operating loss, and the full dividends received deduction is deductible. And all that's saying is that if a company had positive taxable income before taking into account the dividends received deduction, then they would be entitled to the full amount, the full 70% of the dividends received, if the deduction creates a net operating loss. And so for a corporation that owns greater than 20% but less than 80% of a domestic corporation, the corporation can take an 80% deduction instead of the 70% deduction of the dividends received. And for corporations that are owned greater than or equal to or greater than 80% of a domestic corporation, then they can take 100% of the deduction, because essentially if they own 80% or more of the domestic corporation, they are a member, at least a member of an affiliated group, if not part of a parent-subsidiary relationship, and so they would likely file consolidated tax returns. So again, they're entitled to take 100% of the deductions if they own greater than or equal to 80% of the domestic corporation. And just keep in mind now that these dividends received deductions are not eligible if the corporation paying the dividend is a foreign entity. And that makes sense if we think about the purpose of the deduction, and that's to prevent triple taxation. Or a foreign entity not subject to U.S. taxation wouldn't have been paying U.S. taxes on the dividends. And so here we just see a couple of examples where the tax code provides no deduction is allowed. And so if, as we just discussed, the paying corporation is a foreign corporation, then the domestic corporation cannot take the deduction. If the stock was purchased with borrowed money, then the corporation cannot take the deduction. And then the corporation cannot take the deduction if the stock of the paying corporation is held for less than 46 days. And that's less than 46 days during the 91-day period that begins 45 days before the stock becomes ex-dividend. And the ex-dividend date is the first day on which a purchase of stock is not entitled to a previously declared dividend. And again, when we talk about the permanent versus timing differences, now remember we said the U.S. production activities income deduction results in a permanent difference. That is, the income statement and the tax return will never be on the same on the same basis with one another with respect to that dividend. This is true of the dividends received deduction and the income statement. They will never be on the same basis because for accounting purposes in the GAAP produced financial statements, we never book the dividends received deduction. And so, if a corporation's deductions exceed its gross income for the year, the corporation has a net operating loss. The net operating loss is the amount by which the corporation's deductions, including any dividends received deductions, exceed gross income. So, in computing a net operating loss for a given year, no deduction is permitted for a carryover or carryback of a net operating loss from a preceding or succeeding year. However, unlike an individual taxpayer's net operating loss, no other adjustments are required to compute a corporation's net operating loss. If a corporation has a net operating loss, it would not be allowed a U.S. productions activities deduction because it has no positive taxable income. So we also want to keep in mind that a net operating or a corporation's net operating loss carries back 2 years and carries over 20 years. It carries to the earliest of the two preceding years first and offsets taxable income reported in that year. If the loss can't be used in that year, it carries to the immediately preceding year and then to the next 20 years in chronological order. The corporation may elect to forgo the carryback period entirely and instead carry the entire loss to the next 20 years. And a reason that a corporation may elect not to carry back a net operating loss is because its income was taxed at a low marginal tax rate in the carryback period, and the corporation anticipates income being taxed at a higher marginal tax rate in later years, or because it used tax credit carryovers in the earlier years that were about to expire. And so again, we get to this, the importance here of understanding what our options are. And sometimes we end up doing this calculation to see if it really makes sense for us to go back 2 years and then use the remainder spread over the next, or for the next 20 years, or to just not carry back the loss and simply carry it forward. So the corporation makes the election by checking a box on Form 1120 when it files the return. And once made for the tax year, though, the election is irrevocable. And then finally, these net operating losses and the treatment of them are create this temporary differences between the income statement and the tax return, since on the income statement we're saying we have a loss in the current year. For instance, it's a $5,000 loss, and if we go back to those prior years, carry it back for 2 years, it's going to be reducing our income before taxes and may generate a refund for us in those years. Or if we decide not to do that, or even if we do that and we have some left that we carry forward into the next 20 years, you can see that eventually we are using $5,000 of net operating loss reported in the financial statements. We are using those across multiple years, and it may just be 1 year, but we're using those on the tax return so that at some point in time, the loss reflected in the income statement is also reflected in the tax filings, and for these reasons it creates a deferred tax asset because we will get some advantage from that loss from a tax perspective. And so, as we said earlier, the sequencing of the deduction calculations becomes very important in determining the adjusted taxable income number that we use to look at for deduction limitation purposes. As we said previously in an earlier class, the charitable contributions deduction is limited to 10% of the taxable income before the charitable contributions deduction, any net operating loss or capital loss carryback, the dividends received deduction, or the U.S. production activities deduction. But after any net operating loss carryover deduction, once the corporation determines its charitable contribution deduction, it adds back any net operating loss carryover deduction and subtracts the charitable contributions deduction before computing the dividends received deduction. The corporation then subtracts the net operating loss deduction of any before determining the U.S. production activities deduction. And so you can see they all become intertwined and interrelated. And we're going to walk through an example after this presentation how to kind of illustrate how all of these deductions work with one another. So don't worry if if it isn't crystal clear at this point. Just keep in mind that this sequencing does make a difference, and it's important to understand the sequencing so that when you're looking at whether a limitation limits you as far as what you're able to take as a deduction, we can do it in the right order, the correct order. So now let's look at some exceptions for closely held corporations. And when we talk about what a closely held corporation is, it really is where you have a controlling shareholder, which we define as one who owns more than 50% in value of the corporation's stock. In determining whether a shareholder owns more than 50% of the corporation's stock, we have certain constructive stock ownership rules that are applied. Under these rules, a shareholder is considered to own not only his or her own stock, but stock owned by family members such as brothers or sisters or spouse, and entities in which the shareholders has an ownership or benefits an interest. And this could be something like another corporation or a estate or trust. And the reason we have these exceptions, as you might imagine, in these cases is for the shareholders of these corporations or these closely held corporations to prevent them from engaging in transactions that are, again, solely geared toward eliminating or toward preferential tax treatments. And so we have this section 1239 exception that says it applies to transactions between a corporation and controlling shareholders, and it says that the corporation may convert a capital gain realized on the sale of depreciable property between a corporation and controlling shareholder into ordinary income. And so if a company owned, suppose it owned equipment, and it had increased in value and they had it for a while, or property is a better example, property that they had owned for a while. And so they sold it to a controlling shareholder, and because they had owned it for more than a year, they could, this section 1239 could cause that gain to be converted into ordinary income to the controlling shareholder. Then we have section 267, which is another example, and that disallows a loss on a sale of property by a corporation to a controlling shareholder. And so section 267 denies a deduction for losses realized on a sale of property by the corporation to a controlling shareholder, or on a sale of property by the controlling shareholder to the corporation. So if the purchaser later sells the property to another party at a gain, that seller recognizes gain only to the extent it exceeds the previously disallowed losses. Should the purchaser instead sell the property at a loss, the previously disallowed loss is never recognized. And so, again, what we're saying is that whether it's the shareholder selling to the corporation or the corporation selling to the controlling shareholder, if a loss occurs on the exchange of that property, neither the corporation nor the controlling shareholder, depending on which way the transaction is going, is able to declare that loss. However, if they later sell it, the owner of that property later sells it at a gain, well, then the amount of the loss that was created as a result of the initial transaction will be deducted from that loss, and so the amount, or from that gain, and so the amount of the gain will be what's left over between the two. And again, these are all geared toward preventing a controlling shareholder from manipulating or otherwise abusing transactions for solely tax benefits. And so also Section 267 defers a deduction for accrued expenses or interest owed by a corporation to a controlling shareholder or by a controlling shareholder to a corporation when the two parties use different accounting methods, and the payee thereby includes the amount in gross income later than when the payer accrues the deduction. Under this rule, accrued expenses or interest owed by a corporation to a controlling shareholder may not be deducted until the shareholder includes the payment in gross income. And so again, we're trying to, under Section 267, prevent the timing issues that we talked about very early in the semester, prevent how taxpayers can manipulate the timing of events in order to minimize taxes. And so we have that where controlling shareholders and corporations use different accounting methods, and so that would be perhaps one using the accrual, the other using the cash method. They are prevented from taking the deduction, or they defer the deduction under the circumstances we just talked about. And then finally, we have what we call at-risk rules. That's where if 5 or fewer shareholders own more than 50% of a corporation's outstanding stock at any time during the last half of the corporation's tax year, the corporation is subject to at-risk rules. In this case, the corporation can deduct losses pertaining to an activity only to the extent the corporation is at risk for that activity at year end. Any losses not deducted because of the at-risk rules must be carried over and deducted in the succeeding year when the corporation's risk with respect to the activity increases. And so really what we're saying is that a company has to really be subject where they fall into this fewer than 5 shareholders owning greater than 50% of the stock during the last half of the corporate tax year in order to get that deduction for losses that pertain to activities. They really can't take it unless they really are at risk. They really could lose the, it really is a realizable loss for them. Otherwise, they aren't able to take them. And then we have this idea of personal services corporations, and these are closely held C corporations that are subject to the at-risk rules we just talked about. They may also be subject to the passive activity limitations. So, and that what that says is that if the personal services corporation doesn't meet material participation requirements, its net passive losses and credits must be carried over into a year where it has passive income. So they can't take the loss related to passive activities. Personal services corporations can't take the loss related to passive activities unless they meet these at-risk rules, and if they do, then they must be carried over to a year when they have passive income, so the loss offsets the income. And so these are just a few exceptions or limitation rules around certain very specific instances that are regarding closely held corporations and personal services corporations. And so next we want to cover a little bit of, with respect to computing a corporation's income tax liability. And so under this scenario, what we're talking about is we want to talk about some general comments and rules around the taxes. We want to talk some just about the income tax formula, and then we want to talk a little bit more about this personal services companies and what that means. So in general, we know that the tax rates are graduated, and we covered that a few weeks ago, if you recall, when we looked at our tax rate schedule, where from the first dollar to a certain limit, we're taxed at a certain amount, and from that limit forward, it was taxed to the amount on the first increment plus a certain percentage of the second increment, and so on and so forth, until we got up to where a corporation made $18.3 million, and so they paid tax in the graduated scale up to that $18.3 million, and then beyond that, they paid 35% tax. So that's what we mean when we say that the tax rates are graduated. And so now let's look a little bit at the just the formula, how we calculate the regular tax liability before we take into account any of all the credits we've been talking about. As we said before, we take all of our gross income, which, as you all recall, I know we've said it several times, that's everything, unless the tax code says something shouldn't be included. So gross income is everything except what the tax code says we can exclude from gross income. We deduct our deductions and losses. We deduct our special deductions, and we get to taxable income. We multiply our taxable income by the appropriate rate or rates, and so we get our regular tax liability before credits. Now, we want to take into account that credits are different from the deductions we've been talking about. The deductions we've been talking about are with respect to dividends received deductions or personal U.S. production activities deductions. So we're deducting income, we're deducting from income to get taxable income. At that point, we calculate a rate. That gives us what our tax liability is. And then we have certain credits that we can apply to that tax liability to reduce it down further. And certain examples of these credits, which reduce our tax liability dollar for dollar, right? So the deductions didn't, for every dollar of deduction, we didn't get a dollar reduction in tax liability because of the tax rate that the corporation may have been in. But credits, because they are deducted from our overall tax liability, deduct what we owe in taxes dollar for dollar. And there we talk about foreign tax credit. There are certain other credits that we'll talk about, and then we may add or subtract certain credit recapture provisions to get us to our regular tax liability. And then once we've gotten to our regular tax liability, we have to add any alternative minimum tax liability, and we'll talk about what that means. There may be certain special taxes that we have to take into account that we add, and then we also, as a corporation, we would have paid estimated or made estimated tax payments throughout the year, which we deduct from the regular tax liability plus the alternative minimum tax and any other special taxes, so that once we've done all of that, we get a refund or tax due, and that's what we either write the check to the IRS for, or we expect a check back from the IRS for. So let's talk a couple minutes about this personal services corporation idea. The Personal Services Corporation, and the reason that this becomes important is that they are denied the benefit of the graduated corporate tax rates. So all of the income for Personal Service Corporation is taxed at a flat 35%. So the very first dollar of income is taxed at 35% versus a 15% tax rate that's applied to taxable income for corporations that are between $0 and $50,000, and then you recall between $50,000 and $75,000, the tax is $7,500 plus 25%. Between $75,000 and $100,000, the tax is $13,750 plus 34%, and so on and so forth, according to the table we looked at earlier. But if you're deemed to be a personal services corporation, from the very first dollar of taxable income, you're taxed at a flat 35%. And substantially all activities we see here involve services, such as health, law, engineering, architecture, accounting, actuarial science, performing arts, and consulting. So if substantially all of its stock is held directly or indirectly by employees performing these services, or retired employees who performed the services in the past, or their estates, or persons who hold the stock in the corporation by reason of death of an employee or retired employee within the year, then that becomes a personal services corporation. And so, this is what we just said, that is substantially all of the stock is owned by these people. And so they're generally either people who perform the services now, or who performed them and were paid for it previously, or through estates or through heirs own the stock. Then the corporation is deemed to be a personal services corporation and taxed at 35%. So the reason that we have this rule is that it encourages employee owners of personal service corporations either to withdraw the earnings from the corporation as deductible salary, or to make this S election to turn the corporation into subchapter S corporation, which we talked about very early on. And as you may recall, that was treated as a pass-through organization, which meant that all of the income earned by the company became taxable to the shareholders, to the S corporation shareholders. Although you may also recall that there were certain rules around, what constitutes an S corporation, and so the reason those rules aren't in place, a company doesn't make the election to become an S corporation, but yet they meet these other requirements, then they're treated as a personal service corporation. And again, the first dollar is taxed at 35%. And so now we're going to move into a discussion on controlled groups. And we want to talk about, so why do we need special rules for controlled groups? And I think a lot of that is somewhat intuitive, and I think you'll get that when we start talking about it based on what we've discussed in sort of tax abuses up to this point. We want to define a control group, the special rules that are applied to control groups, and then we want to talk about consolidated tax returns. And so we need these special rules for control groups so that we prevent shareholders from using multiple corporations to avoid having income taxed at 35%. It would be easy to see where if you had an owner who controlled 2 or 3 corporations, that there would be a way through transfer pricing to manipulate the net income of those corporations to perhaps keep each one in a lower tax bracket, rather than having for one corporation to recognize all of the net income, which might throw them into a higher tax bracket. And so these special rules are really created to prevent controlling shareholders from manipulating the earnings of corporations, multiple corporations that they own, in order to stay into a lower tax bracket. And so we asked them, well, how do we define a control group? And so that a control group is comprised of 2 or more corporations owned directly or indirectly by the same shareholder or group of shareholders. They can fall into 3 categories: parent-subsidiary control group, brother-sister control group, or a combined control group. Each of these groups are subject to the limitations that we just talked about. In a parent-subsidiary control group, we have one corporation, that's the parent corporation, that must directly own at least 80% of the voting power of all classes of stock, or 80% of the total value of all classes of stock of the second corporation, referred to as the subsidiary corporation. So the group can contain more than one subsidiary corporation. If a parent corporation and the subsidiary corporations or any other members of a control group in total own at least 80% of the voting power of all classes of voting stock, or 80% of the total value of all classes of stock of another corporation, that other corporation is also included in the parent-subsidiary group. And so in this example, we see that parent corporation owns 80% of Axle Corporation and 40% of Wheel Corporation. Axle Corporation owns 40% of Wheel Corporation. So in this example, Axle is the sub or the subsidiary of the parent corporation due to the 80% direct ownership, and Wheel is a member of the same parent-subsidiary group because of the 80% combined ownership by both parent and Axle. And so again, we say that Wheel is a part of the same parent-subsidiary group because parent owns 40% of it and Axle owns 40% of it, and parent owns 80% of Axle. And so indirectly, Wheel is owned by parent corporation through its 80% ownership of Axle and the 40% ownership each of those corporations has of Wheel. So that's parent-subsidiary control group. Okay, the brother and sister control groups are really defined with two definitions in the Internal Revenue Code. So one is the 50-80% definition, and the other is the 50% only definition. So under the 50-80% definition, a group of two or more corporations is a brother-sister control group if 5 or fewer individuals or trusts or estates have more than 50% of the voting stock of all classes of stock of each corporation, taking into account only the stock ownership that is common with respect to each corporation, or at least 80% of the voting stock of all classes of voting stock is held of each corporation. So that way, under the 50 to 80% definition, the 5 or fewer shareholders not only must have more than 50% common ownership in the corporation, they must also own at least 80% of the stock of each corporation in the brother-sister group. It's more narrow because the shareholders must meet two tests. And so that's how we define a brother-sister control group. And so if we look at this example, we can see that under the 50 to 80% test, Walt and Gail own 100% of North and South Corporation. Walt owns 30% of North Corporation and 70% of South Corporation, and Gail owns 30% of South Corporation and 70% of North Corporation. So under the 80% test, at least 80%, and in this case it's 100%, are owned by these two shareholders. Under the 50% test, Walt and Gail's common ownership is 60%. So that is 30% of North Corporation is owned by Walt and 30% of North Corporation is owned by Gail. And so they have this common ownership, which is greater than 50%. So there again, it's it meets the requirements of the 50% test. And then finally, we have this combined control groups, and that's where 3 or more corporations meet the following criteria. Each corporation is a member of a parent-subsidiary or brother-sister group, and at least one corporation is both a parent and a member of a brother-sister group. And so in this example, we see that Able and Coast are brother-sister controlled because of their common ownership, right, between Art and Barbara, and that able, invest, or parent-subsidiary corporations, right? Because able owns 100% of Best, and so they are parent members of both groups. And so then we, once we made the determination of whether a controlled group exists or not, there are certain items that must be apportioned if they are a controlled group. So low bracket tax rates, for example. Members are limited to a total of $50,000 taxed at 15%, $25,000 taxed at 25%, and $9.9 million or so taxed at 34%. And that's for any brother, sister, or parent subsidiary corporation, right? And then we have the alternative minimum tax exemption. So they are not subject to that, along with the minimum accumulated earnings credit, the Section 179 expense limit, and the general business credit limit. What we're saying with respect to these particular types of deductions or credits are that they have to be apportioned between these brother, sister, or parent subsidiary organizations as controlled groups, if it's deemed that they are a controlled group. And so some groups of related corporations may elect to file a single income tax return, which we call a consolidated tax return. Such a group is called an affiliated group, and that's where there are one or more chains of includable corporations connected through stock ownership with a common parent. And so, in general, includable corporations are those that are other than foreign corporations and certain insurance companies and tax-exempt organizations, and S corporations. And the required ownership criteria are that the common parent must directly own at least 80% of the voting power and 80% of the value of at least one includable corporation, and that one or more group members must directly own stock with at least 80% of the voting power and 80% of the value of each other corporation. So there are some advantages of filing a consolidated tax return, and there are some disadvantages of filing a consolidated tax return. And remember what we said, that if they file a consolidated tax return, what we're really doing is saying we're going to file one single tax return that reports the results for all of the members of the affiliated group. And we talked about this. So what makes up an affiliated group? And that's where one or more chains of includable corporations are connected through stock ownership to a common parent, and that the common parent directly owns greater than 80% of voting power and value of at least one includable corporation. Further, that each corporation owned at least 80% by another member of the group, and if this is the case, an affiliated group may file this consolidated tax return. And this becomes also useful because capital losses may offset capital gains from other group members. So a capital loss that may not be useful to an organization individually, if they meet the definition of an affiliated group, could be used to offset the capital gains from another group. And then operating losses may reduce operating income from other group members. So if we have a net operating loss, rather than carrying it forward as a member of an affiliate, carrying it back and then carrying it forward 20 years, as we talked earlier, as a member of an affiliated group, these operating losses can be used to offset operating income from other group members and reduce the taxable income in the current year. So some of the advantages of a consolidated return are that losses of one member firm offset gains of another member firm, which we talked about. Capital losses of one member firm can offset capital gains of another member firm, and profits and gains from intercompany transactions can be deferred until the sale outside of the group. So this idea of intercompany transactions or transfer pricing doesn't really play into the scenario in an affiliated group, because you really don't get any benefit from them until whatever the transaction happens outside of the group to an unaffiliated member. And for a lot of companies, it saves a lot of time and a lot of management aggravation not to have to deal with these transfer pricing issues. Some of the disadvantages of being considered a part of an affiliated group is that once you've elected to be treated and file a consolidated tax return as part of an affiliated group, it's irrevocable unless the IRS grants special permission. Losses from intercompany transactions are deferred until sale outside of the group. So, we see that that's both an advantage and a disadvantage depending on the particular circumstances. And then you have additional administrative costs, because now you're having to combine and consolidate and really track the effect of transactions not across one corporation but across multiple corporations within the affiliated group, and these can become very expensive cost. And so now let's talk about a few tax planning considerations. One with respect to compensation planning for shareholder employees, then with respect to special elections to allocate reduced tax benefits, and then next with respect to using net operating loss carryovers and carrybacks. Because we're trying to develop some level of insight and knowledge around the treatment of all of these different types of transactions. And so, we want to do that, and we want to come to that understanding before. So open-ended, remember we talked early in the semester about open-ended tax cases where we're able to structure the transactions so as to minimize tax. And we want to minimize tax not solely from one perspective, but from multiple perspectives: the corporation, the shareholders, employees, and so on. So compensation paid to shareholder employees in the form of salary has the advantage of single taxation, because while taxable to the employee, the salary is deductible by the corporation. Dividend payments, on the other hand, are taxed twice, as we discussed. So the corporation is taxed on its income when earned, and the shareholder is taxed on the profits or these dividends when they're distributed. We also talk about fringe benefits. These fringe benefits really provide two types of tax advantages. And it could be a tax deferral or an exclusion. So items like qualified pension, profit sharing, and stock bonus plans provide a tax deferral. That is, the corporation's contribution to such a plan is not taxable to the employees when the corporation makes the contribution. Instead, they are taxed on the benefits when they receive them. We have other common types of fringe benefits that include group term life insurance, accident and health insurance, disability insurance, and these types of payments are exempt from tax altogether. That is, the employee is never taxed on the value of these benefits. So because the employee excludes the value of fringe benefits from gross income, the marginal individual tax rate applicable to the benefits is 0. And so, for example, if you're employed at a company and they have a 401k plan, and part of their plan provision allows for profit sharing, well, at the end of the year, based on whatever the plan provisions are, perhaps a certain percentage of contribution is made to your 401k. You as an individual are not taxed on that contribution. It simply goes into your 401k, and it continues to generate, hopefully, income and earnings over many, many tax years. You're not taxed on the income or earnings either. It's not until you begin drawing down on the 401k proceeds do you get taxed. And with the thought process being you're older and you're retired, you'll be in a lower marginal tax at a lower marginal tax rate, and so you won't be paying as much tax. And so this is part of the whole idea of compensation planning. And so a control group may elect to apportion the tax benefits of the 15%, 25%, and 34% tax rates to the member corporation in any manner it chooses. If the corporations elect no special apportionment plan, then the $50,000, $25,000, and $9.9 million amounts allocated to the three reduced tax benefit rates are divided equally among all corporations in the group. If a control group has more than one group member that report little or no taxable income, the group should elect special apportionment of the reduced tax benefit to obtain the full tax savings resulting from the reduced tax rate. So that is to say that, why would you have a corporation that's in a lower, if a member of a control group that has no taxable income, you should take its income and apportion it with the other members of the control group so that you can increase the benefits to members with the highest income. And so we discussed using net operating carryovers and carrybacks, right? So we have two options: carry back to the second previous year and then to the first previous year and then forward, or forego the carrybacks and carry forward. So in this case, we said that a corporation might elect to forego a net operating loss carryback if it would offset income at a low tax rate, resulting in a small tax refund compared to greater anticipated benefit of the net operating loss instead were carried over to a high tax year. And so, if I were in a lower tax rate and I were already in the 15 or 25% tax rate, and I thought I was going to be in the 35% tax rate in coming years, then why use the election to carry net operating loss back? Why not save it and use it moving forward to get me into a lower tax rate as I move forward, or to at least pay less or pay tax on less income at a 35% tax rate? And so what we want to do under those circumstances is to maximize our tax benefits by examining prior and expected future marginal tax rates, so we're able to receive the greatest tax benefit as a result of the use of the net operating loss. And so now let's talk a little bit about compliance and procedural considerations, specifically in this slide with respect to estimated taxes. So estimated taxes are required if a corporation owes greater than $500 for the current year. Once a corporation, and what a corporation does realistically is it sits down and it projects what its gross receipts are going to be, it projects what its expenses are going to be, it projects the calculation of all of the deductions we talked about, and projects any credits, and it comes up with an estimated tax liability based on that. And so if that tax liability ends up being greater than $500 for the current year, they must pay this $500 in 4 installments. Each installment is 25% of their annual liability. If they don't do this, they'll end up with an underpayment of taxes. And if that becomes the case, then the only thing that happens here, one, is that if it's a small corporation, that is that they don't have, their taxable income was $1 million or less in any of the 3 preceding tax years, then they pay the lesser of 100% of the prior or current year's liability. And so we just spend a second here talking about filing requirements. The corporation must file a tax return every year. They use the Form 1120, which we handed out in an earlier class. If the corporation did not exist for the entire accounting period, it must file a short period return, which we talked about before, for the part of the year it did exist. For tax purposes, a corporation's existence ends when it ceases businesses and dissolves, retaining no assets, even if state law treats the corporation as continuing for purposes of winding up its affairs. The corporations have to file these returns by the 15th day of the 3rd month following the close of their tax year. They get an automatic extension with the filing Form 7004, application for automatic extension of time to file certain business tax information and other returns. However, even with having filed this, they have to have paid at least what they estimate their tax liability to be. And then we have that large corporations, and those are defined as assets with greater than $1 million in net income or assets that are greater than $10 million have to fill out detailed Schedule M3. And M3 is a part of the 1120. Schedule M3 is part of the 1120, which really points to a reconciliation between taxable reporting results and GAAP or financial statement reporting results. And here we see the schedule, here we see the Schedule M2, which talks about an analysis of unappropriated retained earnings. And so essentially what we're saying is on line 1, we have our balance at the beginning of the year, and this schedule is right off of the 1120. We have net income or loss, which we add or deduct from our beginning balance or retained earnings balance. And then we have our federal tax refund in this case, which gives us a $765,000 end of year retained earnings. Then we have distributions that we reduce, and these are cash distributions, so these are going to be dividends generally, that we reduce the $250,000, which we reduce the $765,000 from line 4 by to get us to a balance of retained earnings at the end of the year of $515,000. And so again, this is just a schedule that's completed as a part of the tax return that reconciles retained earnings, because we haven't talked about it yet, but and we'll talk about this in the next session, but it deals with the distribution of dividends or what we call those as non-liquidating distributions, and they have to come from current year earnings and profits or prior year earnings and profits, and if they don't, they are subject to certain other tax consequences for the shareholder. And so this schedule gives the IRS part of the information they may need in order to determine whether or not these dividends should be considered as liquidating or non-liquidating dividends, and what that may mean for the individual receiving them. So you can see it can get a little complicated. And we'll walk through all of this, and I have no doubts that you all will be able to pick this up. Okay, so we've talked off and on so far about this idea of temporary tax differences and temporary differences and permanent differences. We talked about deferred assets. All of these subjects are a part of or have implications for our financial statements, and these are covered by these implications are covered by this Accounting Standards Codification, or ASC 740, which is issued by the Financial Accounting Standards Board, or the FASB. And so what we want to talk about here are items like the temporary differences, deferred tax assets and valuation allowances, uncertain tax positions, and how the Accounting Standards Codification 740 relates to that, balance sheet classifications, and then tax provision process. So the ASC 740 establishes principles of accounting for current income taxes and for deferred taxes arising from temporary differences. Specifically, they address financial statement consequences of revenues, expenses, and gains or losses that are recognized for tax purposes in an earlier or later year than recognized for financial statement purposes. That is, timing differences, right? Other events that create differences between book and tax basis of assets and liabilities, that is, valuations, and operating losses and tax credit carrybacks or carryforwards. This ASC 740 essentially it sets out two objectives. So the first is to recognize current year taxes payable or refundable, and then secondly, to recognize deferred tax liability and assets for the future tax consequences of events recognized in a firm's financial statements or tax returns. And so that's what we're saying here, right? That's the objectives of the ASC 740. For financial statement purposes, this provides us with the guidance we need with respect to recognizing our current year taxes payable or refundable that get recorded on the books and in our financial statements, and to recognize these deferred tax liabilities and assets and what the future tax consequences of events are on our financial statements or tax returns. So again, we have GAAP and we have certain treatment of certain expenses on one side, and then we have the IRS code and certain treatment of those same transactions for tax purposes. Somehow, if there are implications of the differences of those for financial statement purposes, GAAP requires us to generate financial statements that reflect those differences. And so here again, we just talk about some of the issues we just spoke about, whether it's revenues, expenses, gains or losses recognized for tax purposes in an earlier or later year than recognized for financial statement purposes, other events that create differences between book and tax basis, and then operating loss and tax credit carrybacks or carry forwards. And so this just gives us a couple of examples with respect to temporary differences which create deferred tax liabilities. So when we say deferred tax liabilities, we mean that we're creating a liability on the books now, not because we're paying taxes now, but because we're deferring paying the tax. So we're creating a tax liability now because we're doing something in the financial accounting for certain transactions that won't be done on the tax return to determine our tax liability. And examples of those would be where we have revenues or gains that are recognized earlier for book than for tax. So the book is going to end up with a net income that would be higher, so for book purposes we would calculate a higher taxes payable than we would on the tax return, so that creates a deferred tax liability. Same would be true with expenses or losses deducted earlier for tax than for book, or if we look at the tax basis of an asset as less than the book basis, or the tax basis of a liability is greater than a book basis, these all present us with temporary differences between accounting and tax calculations that create deferred tax liabilities. And again, ASC 740 provides us guidance in how we treat these transactions, the results of these transactions. And so the opposite would be true with respect to these transactions, where, and in that case, we would create a deferred tax asset, which means that we're having to pay tax on them now, but for book purposes, we aren't going to recognize the result of the transaction till later, but we won't pay tax on it later, so we'll simply reduce the amount of the asset when we record the tax expense. And so examples like those are where revenues and gains are recognized earlier for tax than for book, expenses and losses are deducted earlier for book than tax, or the tax basis of the asset is greater than book basis, tax basis of the liability is less than book basis, or we have loss or credit carry forwards that exist. And so again, what we're looking at here are just examples of some transactions that say, well, on the tax return, we're going to recognize those expenses in the current period. So we're going to pay tax on those. But in the book, on our books, however, for financial statement reporting purposes, we're not going to recognize the results of those transactions. But we have generated, because we've already paid tax on the results of those transactions, we've created sort of like, think of it as a prepaid expense. We prepaid the taxes on the results of those transactions, even though we haven't recorded them on our books. Well, it's not a prepaid expense with respect to the definition, because prepaid is a current asset and so on, but it is a deferred tax asset, which we then will draw on and draw down later on as we record those transactions on our books. So we talk deferred tax assets or deferred tax liabilities. We can also talk about deferred tax assets and the valuation allowance. And so we create a deferred tax asset when the firm will realize a tax benefit of an event in the future, and the valuation allowance is used for a portion of the benefit not likely to be realized. And so ASC 740 also provides us with guidance with respect to uncertain tax positions. And when we're talking about uncertain tax positions, really what we're talking about are a firm that takes a position in claiming a tax benefit that might not be sustained under IRS scrutiny. So perhaps we've got there's a transaction has happened. We're not exactly sure if the IRS will agree with our tax treatment of that when we file our taxes, and so that creates this idea of an uncertain tax position. And ASC 740 provides us with guidance on how we treat those transactions. And so in applying the tax position standard, the firm will take a two-step approach. First, we determine whether the tax position has a more likely than not or greater than 50% probability of being sustained upon an IRS examination. So there's a 50% or better chance that the IRS will buy the way we treated it. That determination requires substantial judgment and necessitates careful documentation for the financial statement audit and any IRS examination. If the tax position does not exceed this threshold, the firm cannot recognize the tax benefit for financial reporting purposes until they have either the position substantially meets the more likely than not threshold, the firm favorably settles the tax issue with the IRS or in court, or the statute on the limitation of the transaction expires. And so then if the firm determines that the tax position meets the more likely than not threshold, it can then or must then measure the amount of the benefit it can recognize for financial reporting purposes. This measure is the largest amount of tax benefit that exceeds a 50% probability of realization upon settlement. And so that defines the two-step approach. So deferred tax liabilities and assets must be classified as either current or non-current. If related to another asset or liability, the classification is the same as the related asset. So if the tax asset or liability is related to a current asset or liability, it's current. If it's non-current, then it's treated as non-current. If the deferred tax liability or asset does not relate to a particular asset or liability, it is classified as current or non-current depending on its expected reversal date. Once classified as current and non-current, all current deferred tax liabilities and assets must be netted and presented as one amount. Similarly, all non-current deferred tax liabilities and assets must be netted and presented as another amount. And so the next couple of slides are just simply meant to provide what are the steps that we go through each year when we record our tax provisions in our financial statements. And you can see that first we identify the temporary differences in any tax carry forwards. We prepare our roll forward schedules. We apply the appropriate tax rates in the roll forward schedules, which are based on these temporary tax differences to determine whether we have a deferred tax asset or liability balance. Then we adjust the deferred tax assets by valuation allowance if necessary. We then adjust our income tax expense for any uncertain tax positions under ASC 740, which we just talked about. We determine what our current federal income taxes payable will be. So that's what is our current tax expense. We determine the total federal income tax expense. Then we prepare and record our tax journal entries, prepare our tax provision reconciliation, prepare our tax rate reconciliation, and prepare our financial statements. So this is just meant to give us an appreciation of the multiple step process that it takes to get to generating financial statements and what's taken into account in those financial statements. We won't spend any more time on these slides because this process is really discussed in a financial statement presentation class and not so much in a the actual federal taxation class. But I do think it's important that we have some appreciation for the fact that what we're doing with respect to taxes also impacts the financial statements. So after having listened to this presentation, I'd also like for you to go in and look at another presentation that I'll have where we really walk through an example of some of the deduction sequencing events that we talked about in this session. So thanks again very much for your attention, and we will look forward to seeing you in our next class.